Hi there. We are going to go through Nvidia Corp today and show you how Nvidia performs against its peers and why its overall grade is only B when Nvidia is a darling of the stock market. All right. And for those who are not sure, Nvidia is actually a semicon company that manufactures graphic cards, and its graphic cards is a key component of the AI drive right now, right? The AI boom. So the demand for its graphic cards has gone through the roof, and as you can see from this chart here, Nvidia share price has gone up from the low in the past year of about $112 to $900 over. Okay, an increase of more than 8 times, 8.4 times to be exact. So what drives this growth? Okay, we can go through this report and let's see. Okay, from this chart, right, you can see that Nvidia's revenue has increased multiple folds, especially in the last year. Okay, increased from almost 27 billion to 60.9 billion, or almost 61 billion. All right, and its profits has gone up from 4.2 billion to almost 33 billion. Okay, about more than 9 times. All right, more than 9 times. That explains why its share price, as I show you here, okay, went up more than 8 times earlier. Okay, so the growth is a key factor that drove up Nvidia's share price. And looking at its historical margins, okay, its historical margins has been doing very well as been increasing, except for a dip last year. I mean, 2022, if you recall, there was a semicon slowdown, and Nvidia shares is pretty much hit back then. And but ChatGPT and the AI boom just drive Nvidia shares way up, and also its gross profit margin. It went up. It's now gross profit of almost 73%, extremely high, right? And then this is the industry benchmark, right? This black line here, and it's only less than 39%, 38.9%. So it has extremely high gross profit margin. And if you look at the operating income margin, okay, it's also much way above the yellow line here, which is the median operating income margin of its peers, which is less than 12%, whereas for them it is 54%, right? Much higher than the industry benchmark. So needless to say, it gets grade A for revenue, which is increased significantly. And there's also, as you can see, there's nothing, the system identified that needs to be improved on in terms of revenue growth, and the gross profit as well as a grade A. And then we have the operating income, which is also grade A. All right, it's again, no areas needed for improvement here because it's excellent. So one must be wondering why Nvidia is graded B despite it has scored A for operating profit and revenue. Mainly because the cash conversion cycle is graded B. So what is cash conversion cycle? Cash conversion cycle is a measure of how long it takes for the company to turn inventory into sales and sales to cash after paying off its suppliers, right? So the key components of cash conversion cycle will be accounts receivable, inventory, and accounts payables. In this case, Nvidia's cash conversion cycle is graded B, although it's below benchmark. Of course, the faster they can convert the cash conversion cycle is, the lower the better, right? So you would have it's still below the industry benchmark of 143 days. It has 113. I think it's graded B mainly because it's increasing, right? The cash conversion cycle is growing, which is not as good. Okay, the lower the better here for cash conversion cycle. And then what caused that? Inventory wise, you can see there's a increasing trend for inventory, although it is much lower than industry benchmark of 134 days. So even Nvidia's inventory days is coming at 115, almost 115 days, which is below, but there's a kind of a much higher than the past, right? The past is only like 70 plus days. So that's why it's graded C. Okay. In terms of accounts receivable as well, it has came down quite a lot. Accounts receivable days is basically how long it takes a company collect its debt from its customers, right? It went up to the industry average in 2022. Remember the year that it's not doing that well, but then it came back down, okay, drastically in the last year to 41 days, which is below the industry benchmark of 57 days. But perhaps because of the increasing trend, that's why it's graded B. Okay, you can see that there's still room for improvement because in terms of trend, collection days over time, it needs to improve. Okay, so this app actually will explain why there's what areas they need to be improved on as well. In terms of accounts payable, it is graded D. Okay, D. All right. D mainly because it is below the accounts payable, which means how long it takes to pay suppliers, right? So technically, you want to delay the payment to suppliers as long as possible so that your cash conversion cycle is short, right? Because if you take longer to pay your suppliers, means you don't need, you can use the cash for a longer time. But the thing is this, right? It is still it's not that far away, and perhaps it is irregular. It means up and down. So that's why it's an area that they want to the system flagged out that it perhaps something that is they want to look at. All right. Although I wouldn't think that it's a very serious issue because Nvidia is cash rich and you can pay its suppliers on time. I mean, that's a good thing, right? So then let's go to asset turnover analysis. Asset turnover is the amount of assets, okay, the company, how efficiently the company uses assets to generate sales. So the higher the better, right? Nvidia's average asset turnover is 1.14, which means that $1 of assets can generate $1.14 of sales, which is much higher than the industry benchmark of 0.56, right? So that's why it's graded. Why is it graded B then? Right, since it's so high. I think it's only because last year it was high, right? It was declining for the past few years. So 1 year perhaps it's not that convincing that it's doing well. I mean, it declined from previous high of 0.95 to a low of let's say 0.63, right? Last in 2022 before shooting back up, right? So can this sustain the increase is the key, right? Then you have this ROTA, which is return on total assets. Okay, return on total assets, yeah, it came down as well, but it shot back up. Perhaps it didn't come down as much as assets turnover. So this return on total assets is basically how effectively the company uses the assets to generate profit. Okay, the assets turnover is sales, and this is profit. And the drivers of return on total assets actually is assets turnover and profit margin. All right. And in this case, for Nvidia, you can see that both assets turnover and profit margin both shot up. So both of them drove the huge increase in the ROTA, okay, the return on total assets. And as a result, you got A here. Okay, the return on total assets is a huge, it's 61.68%, which is much higher than the benchmark, which is only 5.7%. Okay, so it's amazing return on total assets here for last year, but before that, 2022, it came down to 9.9%. Basically, this AI boom has really done wonders for Nvidia in terms of performance, right? That's why its stock price went way sky high. And interest coverage ratio, okay, it came down. It was graded A. It's graded A, even though it came down for a while and then it shot back up to the to a stratosphere of 128. Right, it's way above benchmark. It's very safe. It's a very cash-rich company. Interest coverage ratio means how easily can the company pay its interest, okay, based on the earnings it makes, right? And the higher the value, the better, right? So it gets grade A for this. So overall, the Nvidia is performing very well. I would think that it gets grade B, but it could easily get a A, right? If its cash conversion cycle gets a A as well. Okay, so that's all, and I hope you like the video. If you find the video useful, please subscribe to our channel, because we're going to share other stocks, right? The next one we're going to share is probably Microsoft, and then we're going to share others as well. If you want, you can leave comments on what stock you want to see. You can try to do that. Please like our video, and it really encourages us to make more of the similar videos. Okay, thank you.